morning, good afternoon, and good evening. Welcome to Mana TV TV5. You are watching Insight with Praveen Puram live from Atlanta. We have been doing number of shows around the entrepreneurship. Today, we just start one other aspect of M&A, mergers and acquisition. Why is it important, and how is it useful to the community? So this is one of the thought where Mr. Madhu has accepted our esteemed guest today. Good morning, Madhu, for your time.
Good morning, good evening to all the viewers in India.
Thank you. Let's get into the introduction. So I will definitely introduce Madhu. The reason we chose Madhu is he is also like us an NRI or an Indo-American community. And his story of how he came in 1991 and what he has done and more, we will get into the detail. Before that, I would like to introduce you, Madhu, to the audience so that they know who you are. Mr. Madhusudan is the founder and CEO of Vector Spam. He's an enterprise that enables companies to plan their growth exit strategies, engineer inorganic growth and cross-border transactions successfully. He was an early member of NIIT in India. In 1991, he relocated to US and he was the president and COO at the time. He led NIIT's largest overseas operation and was nominated twice for the Atlanta International Business Award for outstanding leadership and role in the growth of Atlanta as an international business center. Subsequently, he became president of NIIT Ventures and led new venture investment initiatives and M&A in US and Europe. An accomplished deal maker, his core competencies include strategic analysis, business evaluation, cross-border issue management, M&A transaction management, and complex negotiations. He's active in TIE and served as a global trustee, chairman, and president of TIE Atlanta. As a speaker, he has addressed audiences at events of the World Bank, IFC, IMF, Institute for International Research, World Education Market, Council for Entrepreneurial Development, Georgia Tech, Emory University, Columbia Business School, SIBF, IIT Mumbai, and UNESCO. At the University of Michigan, he led several boot camps for business owners on exit strategy and value maximization. As a philatelist, he has won several awards in international exhibitions and was recognized by the Government of India for his services to Indian philately. He studied at the St. Joseph College, Bangalore, and the Indian Institute of Management, Ahmedabad. His professional education includes business evaluation at the Harvard Business School. What a fantastic journey, Mr. Madhu. So we really appreciate your time this morning, and most of our audience are business owners as well in the Indo-American community. The main interest here would be to understand what is M&A and what are the strategies of exit, right? So before we get into that, we just wanted to know your journey. How did you get into this M&A? And in a nutshell, in 5 minutes, if you can explain what are the struggles from 1991 to today, and if you can explain the journey, that would be great.
Sure thing. Thank you for having me here, Praveen. So I joined NIIT when it was a startup. So it was a very interesting experience because every day was different, because you had the freedom to do anything you wanted in terms of products, in terms of markets, in terms of strategies, etc. So I used to run their operations in Bangalore and then in Bombay. And by that time, NIIT had also scaled up a little bit and become a larger company with a lot of headcount. And our basic systems were not there for HR, for information systems, for corporate planning, etc., which you needed to scale the company. Mm-hmm. I moved to Delhi to set up all those functions. And in 1990, India went through a major foreign exchange crisis. Mm-hmm. This is all pre-liberalization. And India had about 1 week's foreign exchange, which was adequate to buy oil. So there was a clampdown on all of the other import type activities. And NIIT was importing a lot of products from the United States, software and training products. So we had to figure out a way of getting dollars into India to run the business, existing business. So I moved to the US in 1991. And the idea was to see what we could do here so that we could earn some dollars and send them home. So that was another startup experience after India in the US, looking at this market, trying to figure out what to do because money was very hard to come by at that time. The Reserve Bank of India was very control oriented. Every dollar had to be accounted for, etc. So I came here and realized that the market was very mature for traditional education, IT education business. So we could not launch that, nor did we have the money to launch it. So we ended up launching product development services here in the United States. And we started with IBM as a customer, and that's why I'm in Atlanta. They were our first customer. So I used to live next to them, meet them every week, collect the money because you needed that for cash flow. So it was from that view, a bootstrap type of operation. And that business took off extremely well. And NIT became one of the largest product development companies in the training marketplace, building a lot of products for IBM and then a whole host of computer companies, from Oracle to HP to Sun Microsystems, you name it, they were all customers. And the other business, of course, was software services around Sybase, which was a NIT partner. So both these businesses took off well. And then we also launched a products business under the NIT brand name that took off well. And so fast forward, by that time, India liberalized. So it became a lot easier to do business, in terms of investments, etc. And NIT, we realized that, we had not invested adequately in the US market for its size. Most of it was bootstrap. So we decided that, we should set up a M&A fund and a M&A initiative. So at that time, I moved from running operations into running M&A. And we hired Goldman Sachs and Pricewaterhouse and created a dream team, and because we did not have much experience in M&A.
Okay.
And so towards 99 or so, that's when I moved completely into NIT Ventures to look at these investments. And as you know, markets go up and down. And as we started this initiative, the market was in a dot-com frenzy. So all the assumptions we had made on valuations, etc., were completely blown away. And we could not do a traditional acquisition, even though we had set aside $100 million of fund at that time, which was a first for any, I would say, Indian group to be so aggressive on M&A. But the dot-com valuations were crazy, and we could not do a transaction in that environment. In fact, it was hard to find appointments to meet people you wanted to buy because they had so many investment bankers after them, and valuations were completely crazy. Just to give you a thumb rule at that time, if you were in professional services, the valuation was $1 million per head.
Wow.
So if you had a 100 people team, you could think of $100 million of valuation. So it's just crazy valuations. So we decided that it's not going to work. So what we ended up doing was to set up a venture fund. And the idea was to take small slices of equity, using cash and services as currency.
Okay.
And to become and to invest in businesses that had synergy with the NIT core business.
Okay.
So for example, we invested in a company that gave legacy modernization technology, automated code translation from traditional code, Fortran, COBOL, etc., into C, C++, Visual Basic, etc., that automatic conversion. And that opened up the whole business around legacy transformation, which is a very important business now. Similarly, there were other opportunities, like, for example, doing work in the insurance space, a company that was doing work in the insurance space. And that company, we ended up investing, built all of their software, and then eventually sold it to ADP. So those were all very interesting themes. And then in a 2-year horizon, the market crashed.
Oh my God.
Because dot-com crash happened. And the same companies we were looking at pre.com were now available.
Absolutely.
So then we went and did those acquisitions. We did a few acquisitions here in the US. So I used to look at all those acquisitions from concept to governance, the full life cycle. And so we bought product companies, we bought services companies, we bought companies in the United States, we bought companies in Europe. And this was a very interesting time for me because every deal is new learning. And it kind of keeps you on your toes because you have to look at items at the strategic level, but you also have to look at the nuts and bolts.
Absolutely.
Each one becomes important, right? So I used to find that very exciting. So in 2008, I set up with my partner VectorSpan.
Mm-hmm.
And I looked at two things really. One is I found that companies that do acquisitions find it very difficult to integrate cross-border transactions.
Mm-hmm.
They find it difficult to do cross-border transactions in the first place because either they don't have experience in those markets or they don't understand all the nuances of doing those transactions and then managing those people. I'm talking of non-Indian owned companies now.
Got it.
Similarly, what I found was I met probably 200, 250 founders of companies because I was on the buy side and they were on the sell side. And I could see the kinds of mistakes they make, which would hurt their own valuation. And most of the time, they were not aware of that. So I said, this is an interesting space, and maybe this is where we should focus on. So that's what we do today. We focus on, for the larger companies, we focus on helping them look at acquisitions, especially cross-border acquisitions, or if they want to sell a business unit, we help them sell that business unit. And similarly, for founders, we help them think through their exit strategy. It may take 2 years, 5 years, whatever. But thinking that and helping them make sure that they have taken all the safeguards to protect their valuation or increase their valuation, and then help them with the transaction. So that's what we do today.
Very, very interesting journey, Mr. Madhu. So typically an Indian mindset, right? When you come to this country, we always think of buying and how to expand. So during that 99s and 2000 phase, you have been into multiple positions, from operations to services to product development and to M&A. I know that you said that there is every time you have a change in different companies, the strategies. What made you think from the money, right? Everyone thinks of money, how to earn money. So when you talk about M&A and when you talk about a product development or services, if I were to choose, I will choose selling my services or product development to make money. So how did you think in those days you can make money in M&A? What was your couple of things you might have inspired and thought that this is a good area to earn?
Well, we used to meet a lot of investment bankers. For one, so I had a frame of reference to say how they operate, etc. But I think more important was the fact that in M&A you can significantly alter the value through your expertise.
Okay.
And that makes a lot of difference. So for example, how do you position a company? At what valuation do you position a company, right? It's a pretty open area because companies are not commodities.
Absolutely.
It's not real estate. So
Absolutely.
you don't have clear, especially private companies. Public companies, you already have the benchmarks, where the share price is traded, etc. There's a set valuation for public companies. It's a public valuation in the share market. But for private companies, there is no such thing. And a lot of times, value is created by, first of all, positioning the company well.
Okay.
How you tell the story, right? How do you highlight? What do you highlight, etc. And what we find is that a lot of business owners start looking at their operational problems more and more and more. And they don't put value to the real successes they've had. And that's also a little bit of an Indian mindset, where you're a little humble and And secondly, you also don't think something you have achieved, you don't think that is fantastic. You always focus on, this HR problem or that compliance issue or this customer satisfaction issue. You're always caught in the operational drama. And so for us, the excitement is, how do you pull these guys out of that operational, thinking that they are stuck in, and help them visualize the real value of their business. So there, the value add is very significant.
Absolutely. I think you told the right points. We always think on the operational problems, how you have to scale and how you have to build the company. And telling the story is very important today, as you rightly said. So coming to your M&A strategy, it is a one-time strategy or it's a maintenance? You should be part of the companies guiding them overall. How does this work?
M&A is not a one-time thing. It's an ongoing process. It's part of their strategic growth. So typically what we do is we get involved in the planning cycle itself, because companies, when they do their planning, let's say they're thinking of a 3-year horizon or a 5-year horizon, they're thinking along those lines, then what they can do is they can differentiate what they're going to do organically, which is through operations, and second, what they're going to do through an M&A or a strategic initiative or a joint venture or whatever. So we help them break the growth problem into these two parts. The organic part, they run themselves because that's what their operations team does. And on this part, which we call inorganic or loosely M&A or growth strategy, that's where we help them actually look at what are the alternatives. We go to the market, we find specific companies that may be of interest to them, and then we manage all of the transaction related activities for them. So that's how the model works.
Absolutely. I think before we get into the details of the M&A, I would ask you a basic question. Why are the businesses sold in the first place? What do you think? Why are they sold?
The business is an organic thing. So it never can be left on a sustaining basis on an autopilot. It doesn't work, right? Because a lot of things change. First are the people related issues. So if you take founders, for example, every founder guaranteed grows older every day.
No choice.
Right? So they grow older, they get married, they have kids grow up, kids have to get married, then there are grandkids. So you have on one side the family related issue, which means that if you could spend 20 hours a day when you were a bachelor, as your age goes up, you will have less and less time to spend on your business.
Absolutely.
Energy goes down. Especially if you have had success, capability of taking risk goes down. Then there may be health related issues.
Absolutely.
And so on. So it's the nature of things that from a founder perspective, things will slow down. And the question the founder has to ask is, will I allow this slowdown to happen? Will I become the bottleneck to the business? So that is one aspect of why you should think about growth. And growth and exit are synonymous. Because you want to create value. You can either create value by staying the course, you can create more value by making changes, and you can make even more value by bringing in outsiders who can help. Just like you do with your management team. You bring in a management team for more energy, for more vigor. The same way. Similarly, the business itself is not constant, right? Because businesses have life cycles.
Absolutely.
So what was hot in the 90s and thriving in the 90s, if you stayed on with it in the 2000s, it would not work. I mean, take, for example, some of the really big brand names. Take, for example, IBM PC. Rocking success, or IBM mainframe. Rocking success, workhorse of the industry, and then it's no longer now, IBM PC is no longer IBM.
Absolutely.
Right? Take Motorola. Same story, up and gone. Yeah. Take Apple, the survival issues with Apple. Take Microsoft, how they missed the internet revolution and lost out. Take Google now. See the pressure they have on the chat from Chat GPT, right? Suddenly they are now, their position in the market is threatened. That happens to every business because technology changes, market needs change. And if you have not been investing continuously and rejuvenating yourself, reinventing yourself, chances are that your business is also going to slide. We see this very much with product businesses because product businesses, you make a lot of initial investment, get a lot of headwind, and you are scaling nicely. And over a period of time, especially with license models, companies used to have new license revenue and maintenance revenue.
Absolutely. Now we don't.
Right. Yeah, well, that is part one, that whole model is gone. But even in that model, as the founders grow older and stop investing in new product development, the license part shrinks and the maintenance part expands. And over a period of time, customers stop using the product. So new product license is also gone, maintenance is also gone. So that's the aspect around business, right? The third is around operational issues. Like, for example, cash flow could be an issue. You may have taken on debt and there is a balloon payment that is coming up and you don't know how to handle that balloon payment. So you could have business pressures of that kind. You could have competitive pressures. Like, for example, you could have a venture-led company competing with you or a private equity-led company competing with you. And you need to have profits to continue your business, whereas there they don't care because they are creating value by scaling dramatically. Their focus is not on the bottom line. So they are spending money like there's no tomorrow on sales. They're beating you on pricing, they're stealing your contracts, etc., because their objective is different, whereas you have to run your company for cash flow. So you have all these contradictions. Then sometimes there are industry changes itself, which may affect you. And then there may be environmental changes. So whole host of these factors dynamically change every day. And therefore, you cannot sit still enjoying your success. You have to think, and the only sure way of surviving is growth. There is no other way of surviving.
Yeah. So
and that's why this process becomes important.
So absolutely. Very clearly, I understand that, sustaining the same business to the trajectory, we need to think from the technology, from the investment, from the change of people, bringing new talent. So tell me one thing. If I am into business, for example, when do I need to think to sell? What is the point? And do I need to think from the start how I need to evaluate my company? Tell us more from a basic company, if any of our Indo-Americans are putting. What is that we need to think of building the company, evaluating the company, and selling? What are the points to trigger?
Okay. The first thing is that a lot of times we think of exit as a failure.
Mm-hmm.
And I think that's the first issue around mindset that we have to change. Now, exit is not failure. Yeah. That's a very important message. The second is that a good analogy for this is, do you want to be the owner of a very big part of a very small pie? Or do you want to be own a small piece of a much larger pie? Right? And that's a conversation the owner has to have with himself or herself. Mm-hmm. Because a lot of times we find that business owners are so their identity is so mixed up with their own company's identity that they cannot think rationally about these kind of issues. Mm-hmm. So one of the most important things is to create that awareness, saying that, look, you have to separate yourself from the business. It's not the same. So as a business owner, you have to look at the business in a certain way. As the CEO of the business, you have to look at the business in a certain way. So you have to start looking at it from these perspectives and start creating a little bit of distance and treat the organization or the company not as yourself, not as your identity. Especially, a lot of times founders have their names attached to the
companies. Yeah.
Yeah. So whether it's Ambani Enterprises or whatever else, it doesn't matter. But it's very strong linkage, right? And your identity, your self concept of self-worth, everything is attached to that. And in that context, exit seems to be, what am I doing here? But the concept of exit is very different. The concept of exit is, how do you bring outside capital into your business?
Okay.
Right? To make the business more successful. So that is one aspect of exit. The second aspect of exit is, if you talk to most bankers, they will tell you that private companies owners, their wealth is mostly sitting in their private stock, which is the stock in their company, equity in their company. And that is not liquid.
Okay.
So you may be worth a lot in paper, but depending on personal situations, business situations, market situations, your wealth can scale or it can fall, correct?
Yes.
And so from a risk management viewpoint, their fear is, these owners are not using diversification. We talk about portfolio diversification, but this is the worst example of portfolio diversification, because there is no portfolio diversification.
Absolutely.
So all of their wealth is sitting in their company, doesn't have liquidity. It is prone to the ups and downs of not only the market, it's also prone to the ups and downs of their own business, right? For example, if the CEO has an accident and is incapacitated for 3 months, what happens to the business? I mean, we've had such strange situations. For example, one of the avid golfers, founder CEOs, got hit by a golf ball.
Oh my God. Okay.
And was out for 3 months. What happens to the company? Right? So these are, I think, some practical issues. So these two aspects are very important. One is exit is for growth, one aspect. The second aspect is exit is for portfolio diversification.
Absolutely.
It's a way of hedging risk.
Got it. I think now we understood what is the logic we should put. So when you were saying about you should not be tied to the company, right? So tell us more about how do we keep aside a few examples where a normal person like me can understand. What are the few things we should keep when you are having a company?
Okay. So I think mentally differentiating the role of founder from CEO. I think that's the first important realization, saying that, look, as a founder, I'm accountable to nobody. Right? So I can do what I want. If I want to buy a Bentley, I can buy a Bentley. If I want to buy a jet, I can buy a jet. If I want to, own the building I am in, I can do that. I have all that leeway as a founder, right? But as a CEO, I am accountable for my business. So I need to create a business plan with a horizon, which a lot of founders don't do, by the way.
Absolutely. I'm just hearing all these things. It's very, very interesting.
Yeah, they don't do it. So how do you put together a business plan, right? Second, more important, how do you create a budget for the next year? And most important, how do you make yourself accountable for that budget? Because as a founder, it's okay, if you're off by 10%, up, down, 20% up, down, it's fine. As long as cash flow is there, you have enough funds flow going through, then you're okay. But how do you bring this accountability into that? So taking these two roles apart, that's a very important. And the second way is to create accountability for yourself, is to have like a board of directors or a board of advisors. And what that allows you to do is, even though you may be 100% owner of your business, it allows you to create an environment where you're not playing the role of founder, but you're playing the role of CEO. And you're reporting to the board saying, hey, this was my plan. This went well. This did not go well. This was the reason for the variance. And this is my corrective plan. And you're holding yourself accountable. And that will do wonders to your business. So if you had the opportunity to scale, this will propel you in that direction.
Excellent. So I always get stuck in the board and the founder and CEO. Always, even though they are not owners, but we are answerable to the board. Now I get the point how the relation is happening. Excellent point that.